Money looks harmless, just paper, metal, numbers blowing on glass. But behind every price tag hides a darker question. Who convinced billions of strangers to obey the same visible scoreboard every day? Before money, people traded directly. Grain for fish, hides for tools, labor for shelter. Simple, yes, until the hunter wanted bread and the baker did not want meat today or tomorrow again. Economists call it the double coincidence of wants. Both sides must want exactly what the other offers at the same time. Without that little miracle, trade stalls like a locked vault in winter. Here is the first secret. Money was not only shiny objects. Ancient societies also tracked debts, favors, grain, silver, and promises. The ledger came stalking long before the wallet existed, in silence. Money is anything people generally accept for payment, debt, and pricing. It works as a medium of exchange, unit of account, and store of value, but only when trust survives between strangers. Good money must be portable, divisible, durable, acceptable, scarce, and reasonably stable. A cow may be valuable, but try paying half a cow for noodles, Professor, without making dinner horrifying and legally confusing. Prices are not random stickers. They signal scarcities, demand, labor, risk, desire. When prices move, markets whisper where pressure, hunger, opportunity, and manipulating hide inside your pocket. People work for money because it stores labor portably. Hours become numbers, then food, rent, medicine, status, escape, and sometimes dangerous dreams of freedom. Where trust was thin, coins turned trust into metal. In ancient Lydia, electrium coins carried official marks, telling strangers and soldiers that this small lump had recognized value beyond one village, across roads and armies. A ruler's stamp was not decoration. It was a guarantee, the sound of a spear scraping the ground, a threat, advertisement at once. The coin said, "Trust my kingdom," or at least fear its scale across dangerous trade routes. Paper money rose powerfully in Song Dynasty China, where heavy strings of coins became inconvenient for trade. The trick was elegant. Carry a claim, not the mountain itself, inside your nervous hands. A banknote is not wealth by magic. It is a promise. Society collectively agrees to honor. The paper is cheap. The belief printed onto it is the expensive part, holding the entire market together through shared trust. When trust breaks, money mutates. People flee to goods, foreign currency, gold, or barter. That is why stable money is less a product than a public spell, quietly holding the market together. Governments strengthen money by accepting it for taxes and declaring legal siphon for debts. Suddenly, the symbol gains teeth. Citizens need it because the state demands it, not politely asks, every April. Banks do not merely guard coins in sleepy vaults. They transform deposits into loans, loans into spending, and spending into new obligations, moving through the bloodstream of society, inside a polished financial machine. Credit lets tomorrow's money enter today. Used carefully, it builds homes and businesses. Used recklessly, it becomes a velvet rope around the neck, tightening with interest. Inside a polished financial machine quietly, interest is the price of borrowing time. It rewards lenders, disciplines borrowers, and quietly decides who expands, who survives, and who spends years paying for yesterday's decision with an old banker's smile. Central banks sit near the machinery, adjusting interest rates, supervising stability, and managing currency supply. They are not wizards, but their levers can shake kitchens and empires through very ordinary wallets quietly. For centuries, gold and silver carried monetary power because they were scarce, durable, and desired. Yet metal does not remove politics. It only changes who controls the leash in every bloody century. In 1971, President Nixon ended the dollar's convertibility into gold, helping finish Bretton Woods. Modern major currencies became fiat, valuable because law, economy, and trust say so, almost overnight for global finance. Fiat money sounds like a trick because it is backed by confidence, not a treasure chest. But confidence, my little auditors, can move armies, markets, and breakfast before anyone finishes morning coffee. Inflation means prices rise over time, shrinking what each unit buys. A dollar survives in your pocket, but its purchasing power can quietly leak through the seams without leaving obvious fingerprints behind. Falling prices may sound delicious until buyers wait. Businesses earn less, wages freeze, and debts grow heavier in real terms. Even cheapness can carry poison when the economy starts holding its breath. A bigger paycheck is not automatically richer. If prices climb faster than wages, workers celebrate a number while losing the race against rent, groceries, fuel, and fees, while smiling for payroll photos. Saving is storing choices for later. But money under the mattress faces inflation, thief, and temptation. That is why people chase interest, businesses, property, and markets instead of worship lonely folded paper. Investing turns money into a claim on future production. Sometimes it grows. Sometimes it burns. The dark rule is simple. Higher promised returns usually hide higher danger behind the polished invitation letter. Businesses learn that prices are psychology too. $9.99 feels smaller than 10. Discounts create urgency. Luxury prices create status. The tag is bait wearing atramology and smiling like a helpful friend. Debt is not evil, but predatory debt is a cage. Fees, penalties, and compounding interest can turn a small emergency into a long private punishment in the tired hands of desperate borrowers. Banks rely on confidence. If too many deposits demand cash at once, even healthy banks can wobble. Insurance systems exist because panic travels faster than accountants outside the heavy marble branch doors. In the United States, FDIC insurance protects eligible bank deposits up to set limits. That protection is not glamour. It is society trying to stop contagious fear inside a frightened, nervous economy. The 2008 financial crisis showed money's machinery could poison itself through reckless lending, risky loans, securities, and fragile trust. Screen numbers became foreclosures for families who never read derivatives. The Libri scandal revealed traders tried manipulating benchmark interest rates tied to enormous financial contracts. The quiet number behind loans was not as innocent as advertised, while pretending to be neutral mathematics. Wells Fargo's fake account scandal proved trust can be harvested without permission. Regulators punished the bank after employees opened unauthorized accounts to satisfy the bank's brutal sales pressure. Digital payments are convenient, fast, and trackable. That last word matters. When money becomes data, every purchase can become a footprint. Someone may analyze, sell, or subpoena inside a permanent private ledger. Modern money includes many people, but not everyone. The World Bank still counts over 1 billion adults without formal accounts, leaving them exposed to cash risk and exclusion from safer ordinary finance. Cash is anonymous power in your hand. Digital money is searchable memory. A society must decide how much convenience it will trade for surveillance, control, and speed inside every quiet transaction forever. Bitcoin arrived after the financial crisis with a rebellious promise. Money without central banks. That promise is real as code, but value still depends on belief, inside a brutally volatile market still. Crypto also opened doors for scams, hacks, pump schemes, and irreversible mistakes. Some projects build useful tools. Others sell golden fog to desperate people, chasing escape under neon promises of instant freedom. Money's environmental shadow is old. Gold mining has damaged rivers and communities, while small-scale mining remains a major mercury polluter, as greed digs beneath mountains for shining promises. Digital money is not weightless either. Bitcoin mining consumes serious electricity, and researchers debate the renewable and fossil energy powering that global security machine with a measurable environmental bill. Money measures value, but it also magnifies advantage. Those who own assets can earn while sleeping. Those selling time must keep returning to the clock until their exhausted bodies send silent invoices. Money buys necessities, but also signals rank. Brands, neighborhoods, schools, and weddings become coded messages. Humans call it taste. The ledger calls it positioning for anyone desperate to look like they belong. Taxes reveal the ruler beneath money. The state accepts its currency, then demands it back, funding roads, armies, schools, courts, and the machinery of order, while politely calling the final bill civilization. Counterfeiting is punished because fake money attacks trust itself. Print enough false claims, and honest notes begin to look suspicious in every trembling hand, long after the dishonest ink dries cold everywhere. Rumors say secret cabals control every dollar perfectly. The proven truth is messier. Governments, banks, markets, laws, errors, greed, and fear pull the system together inside one enormous, uneasy machine together daily. Most money today is not physical cash. It lives as entries in bank databases, payment apps, cards, and reserves, moving faster than any ancient coin ever dreamed, inside invisible accounting rooms worldwide. Money is not good or evil. It is a tool that records trust, power, work, debt, time, and desire. The danger begins when you forget that and kneel before the glowing number like a cold little god. Use money, but never worship it. The ledger rewards discipline, punishes ignorance, and belongs most to those who understand the rules before signing their lives away with your own future as collateral.